G'day traders, this is February the 8th, 2021, and today we're going to be talking about money management and how much you should invest in your trading when trading shares. Before we get stuck into this video, I suggest you review my earlier videos, which were titled Simple Trading Strategy and the Average Down Strategy, just to get a better background in terms of what I'm referring to here, so we don't cause any confusion. So let's get stuck straight into it. Firstly, we're going to talk about how many shares. Well, before we go there, let me explain this chart. And you would have seen this chart on my reviews for the indexes and gold reviews, but also for share trading reviews. I want you to focus on three main charts. This chart here is the price chart, and you don't need to see the finer details necessarily. I'm giving you the 18-month view, which goes back to, if you look down here, July 2019. So it's about 18 months of data, looking at a 15-minute time frame chart. That's the price chart. This top chart here is a profitability chart, which shows you the amount of money you've made from an opening balance of $100,000. That's just a baseline. So you can see there a dip below 100,000 to about 99,690 because the share price had dropped, but then it recovered, and so on and so forth. And that's showing the simple trading strategy with the average down technique, and that's what these steps or these bars represent. It shows how many shares have been bought or accumulated in each of these periods. This is another price chart, another profitability chart, but it shows you've bought one set of shares back here at the same time you bought these, but you've held that. So what we're doing here is comparing that profitability versus that profitability. So if you look at here for Caterpillar over a 15-minute chart, you can see there over that 18-month period, the buy and sell strategy with the average down has made $986, and the buy and hold has made $468. For each of these, we're buying without $1,000 lots of shares. Now, I just want to quickly explain how many or number of shares you need to buy. We're basing it on the total dollar amount we're going to invest. So for example, as per the chart, if we're going to invest $1,000 per entry, as per this example, so let's say we go back here, if you look at that where that arrow is, it bought 8 shares at 124.67. That's our entry into that trade there. 8 shares at 124.67. So if we put in 124.67, we don't know how many shares we're buying yet. We're buying $1,000 worth, and that calculates 8. That's simply saying $1,000 divided by 124.67, and it rounds it up to 8. We're always going to invest an optimal amount there, which in this case is $1,000, just to keep it simple. Otherwise, the other way you can do it is say, I want to buy 10 shares each time. The problem with this approach is if you say I want to buy an arbitrary amount of 10 shares per trade, then for example, in this example, you would have bought 10 of, for example, 124.67 as per the previous chart, you would have outlaid $1,247. Go back to the chart for a minute. With the first method, let's go back here. It bought 7 shares at 137.48. So 137.48. It bought 7 shares. Let's do that here. If we bought 10 shares, you would have outlaid $13.75. So going back to this average down process, it bought more shares here. It bought 8 shares at 124.08. So put in 124.08, it buys an additional 8 shares. Whereas if you put 124.08 there, you would have spent $1,241. So the idea is each time we're buying shares, we're buying $1,000 lots. We're not buying the number of share lots. Just to keep it consistent with the money management technique. But you can do it either way. I prefer to do it this way. If you have the funds, you can do it this way. If you want to buy 10 or 20 lots of shares or whatever it may be for your particular stock that you're buying. So what we're going to do now is compare the trades. I want you to know this is a bit busy. You may want to pause the video at some point and absorb what I've just said after each comment. I want you to focus on this orange section. So we're trading $1,000 lots per trade. So again, in this example, we're trading $1,000 lots. Now we're looking at Caterpillar here. Over the 18-month period, it's made $986 for the simple trading strategy, and it's made $468 to buy and hold. And those amounts have simply been plugged in there. 986, 468. We did the same exercise with these other companies, and I've just chosen some random blue chip shares: BHP Australia, JP Morgan, Johnson & Johnson, and Caterpillar. And so for each of those buying $1,000 lots, you can see there the profits made for each lot for the buy and sell strategy, and the profits made for the buy and hold strategy. So overall for the 4 stocks there, it's made $2,040. This one's made $1,059. Why am I showing you these other 2 there? Is because here, if we traded $2,000 lots, you're not automatically doubling your profit. So here, that amount there is double that. The buy and hold strategy is double that. In this example, $5,000 trades. So in other words, 5 times that is that, and 5 times that is that. In reality, if you're using $1,000 trades as your baseline, you're not actually buying 200% of that, you're actually buying 246%. So that 5,023 profit is more than double that. That 13,974 is more than 5 times that. Okay, so that is 685% of that, if that is 100%. So I'm just demonstrating that buying multiples of whatever you start with, you're going to do better than the multiples outlined in this example. I hope that makes sense. So in other words, if you start with $1,000 lot trades, let's say in your first 6-12 months you've been doing this, $1,000 lot trades, and then you upgrade it to, okay, I'm going to decide I'm going to double that, I'm going to put in $2,000 lots per trade, then you're going to do more than double your profits. And these profits, by the way, are allowing for brokerage in my model that I've tested. So just something to keep aware of. Now, lastly, I want to talk about the rules. So, determine how many blue chip stocks you want to buy. Now, I'm using as an example, we should trade 4 companies, 4 stocks. Now, if you can afford the time and you want to invest in 10 stocks, that's up to you. But I'll give you the pros and cons. So, determine how many blue chip stocks to invest in. This depends on how much capital you have. So let's assume you've got $10,000 to invest. How much to invest per stock per trade? And we're saying we're going to do $1,000 per trade, or roughly 10% of your total funds. So again, we're buying those 4 companies. On our initial entry, it's going to cost us to invest $4,000. And we need to allow to inject funds into the account if required. So if you've used up your initial $4,000 to buy those 4 shares, and you need to buy additional shares for the averaging down technique, such as in this example, you bought your first lot of shares there, that cost you about $1,000. You bought your second lot of shares there for Caterpillar, that cost you another $1,000, so that's, so far you're invested $2,000. And down there, according to our average down strategy, you've invested another $1,000 worth of shares. So now you've got $3,000 worth of invested in shares. You invested another lot there, $4,000. So overall, up to this point, we've invested $4,000 in Caterpillar shares. Now, one thing you'll notice is the more you average down, the higher your returns will be when they do make a profit. But you've got to be careful. you don't artificially enter too many times, otherwise you'll deplete your funds a lot quicker. So, as per the example, how many stocks should you trade? I'm assuming you've got an available fund total of $10,000, we're going to trade 4 trades, 4 stocks. That equates to about 15 to 30 minutes of your time daily to review the results. So 15 to 30 minutes each day, you come into your trading software, bring up your chart and say, righto, the chart's either going in the right direction. Say, look, as in this example, the chart's going in the right direction. If you can automate it, great. If you want to do it manually, you can still do it manually and let it go. In this example, you let it go. In this example, you bought your first lot of shares there, you watch it, okay, it's dropped. It's dropped to a certain percentage drop or number of points drop according to your average down strategy, so you buy more. It's dropped another percentage drop, you buy more. Here in this example, it's bought more in a bit of a sideways move, but then it closes out with a profit. So you can see there it closed out there with $749, whereas back here it started when you first made your first entry on that particular trade, $263. So it made about $500 in those few months for that average down trade. These other ones were all single buy and sell entries and exits without averaging down. So again, assuming you've got $10,000 to invest, you buy 4 stocks and your initial outlay was $4,000. So we need to review the charts daily, find out where to set the targets and close out the positions, or if the price goes against you, you do your determining where to add to your positions for the average down strategy. So allocating the amount of your budget or your funds to trade, how much can you put aside monthly from your take-home pay? So let's say, for example, you get paid $5,000 a month, you may decide to trade $1,000 lots. Now, if you've got a $10,000 initial investment fund, then this is in addition to that. So in this example, we outlaid 4 blue chip stocks, that would require $4,000. So out of that $4,000, the remaining $6,000 is kept aside in cases of adding to your positions. Okay, as we said, in such cases, you would need to add to the positions, and they roughly equate to about 1 every month, or maybe sometimes 2. In this example, that entries were made in March. Then another month went by, no entry, another entry made in May. These ones, you entered once, no additional entry. So you only entered, if you're trading $1,000 amounts, you only entered one trade, $1,000 trades there. And you do that the same for each of the other stocks as you're reviewing your strategy. So you can see here for JP Morgan, that had a very similar, instead of 2 entries in March, you had 1 entry. So the first entry was made around the same time as Caterpillar. Your second entry, an additional $1,000 funds were made in March. Remember, Caterpillar, you had 2 additional entries in March. No additional entries in April for Caterpillar, nor for JP Morgan. You had 1 additional entry for Caterpillar in May. In this example, you got 2 additional entries in May. So that's what I'm saying, that $6,000 amount for all your 4 stocks, whatever they may be, and I've chosen these 4 as an example. I'm not suggesting you trade these. You need to make sure that you've got funds available to add to your positions if necessary. So initial outlay would have been $4,000, starting balance would have been $10,000, so you've got $6,000 in your back pocket to use in an average down situation if any of your 4 stocks were requiring additional entries. If and only if your $6,000 funds were depleted, then allow for additional monthly injections into your account from your take-home pay. So hopefully your $6,000 will keep you going and keep you alive, and your profits will build upon that amount on your total funds, and you won't have to add additional funds from your take-home pay. But if and only if those additional $6,000, as in this example, were depleted, you'd want to add more funds from your take-home pay or from any other income source you have outside of this trading account. So there's quite a bit of information there. In summary, try and manage your account based on your starting account. In other words, if you've got $10,000, don't enter into 10 separate stocks at $1,000 each. Make sure you've got additional funds available should you need to add to your positions, as in this example. Quickly looking at those 4 stocks. JP Morgan, you added to your position once there, and 1, 2, 3, 4, 3 times there, so 4 times over the 18-month period. For Caterpillar, similar, you added 1, 2 positions there to that initial entry, and you added 1, 2, 3 positions there to your initial entry. All the other entries were single entries of $1,000 lots. Johnson & Johnson, which is one of our other demo stocks we're using as an example, all single trades except for 1 additional entry here. And lastly, just to demonstrate BHP Australia, this one had a bit more movement, similar to Caterpillar and JP Morgan. Additional entry there, additional entry there, another entry there, and another entry there. So guys, hopefully that helps make some sense in terms of how to manage your account and what sort of funds to allocate for each of your trades. And please follow the rules. You don't want to be caught with your pants down and lose. You're not going to lose the money if you do it properly. Worst case scenario, the company you're trading goes out of business. Next worst scenario is you run out of funds to add to your position. So as in this example, if you use all your, let's assume you start with $10,000 in your account, you've entered your $4,000 for initial entries for your 4 trades, then you've added those additional $6,000 you've added to your positions across the 4 trades, and you need to add another position because your indicator says you need to add another position, and you've got no more funds, then you're gonna have to wait until you ride out the storm. You haven't lost the money, you're just riding out the storm until it recovers, or until you get additional funds to enter into the position according to your average down strategy. And remember, what we're trading here are blue chip shares. So if and only if the stock goes sideways for an extended period of time, then you're going to be getting some dividends in the meantime. And again, follow my simple trading strategy and average down strategy videos to identify how to choose blue chip stocks that pay decent dividends in times when the market goes against you and you can't average down. All right guys, see you in the next video. Happy trading. Bye-bye.